Welcome everyone. Hello, my name is Greg Leparati. I'm Associate Director of Alumni Relations. Pleasure to see you all here this evening. A few quick ground rules before we begin. I would request that everyone please mute their microphones. You can leave your cameras on. We like to see our guests' smiling faces, but definitely mute your microphone so we don't get any ambient noise throughout the presentation. I'm delighted to have you all here for our first financial literacy event of the semester, and I'm excited to be joined by Alan Chen, who has been leading a number of these. Alan, a quick background about Alan. He graduated in 2017 from Baruch, and after he got his first job out of college, he realized that despite going to a business school and learning all about accounting and finance and everything, he knew nothing about how to handle his own personal finances, which is what sort of got Alan on this crusade to increase not only his own financial literacy, but everyone's. And so Alan has become sort of an armchair expert on financial literacy, and he's kind enough to share that knowledge with Baruch alumni and students. So he's been doing presentations for our office and alumni relations, as well as the Star Career Development Center. We're super grateful to have Alan here doing this for us. We will be recording this and sharing the video afterwards. So for all those wondering, we will share that video in the next day or two. And just a little bit about Alan, he works as a software engineer at Rent the Runway. By evenings, he is a financial literacy armchair expert who's here to chat with us about retirement and how to pick retirement funds. So please direct your questions throughout the presentation to the chat bar. Alan will get to as many as he can as he's going through his presentation. And with that, I now introduce Alan Chen.
Thanks, Greg. Welcome to the Financial Literacy Workshop. I usually host these workshops on a monthly basis during the fall and spring semesters. I don't remember if Greg mentioned it, but we are sharing the recording and the slides with the speaker notes. So everything will be available. So don't worry too much about if you missed something, but do be sure to ask questions in the chat. I'll be sure to answer them as I go along. And if for anyone else who is a financial literacy expert as well, feel free to pitch in. You know, I don't want to be here alone answering everyone's questions. I'm sure there are people who are capable as well. I also run a blog on the side to moonfund.com where I write about personal finance and retirement and just things that interest me in that regard. And really, when I think about retirement funds, I'm specifically talking about your 401k. Right? Just because I have an experience with a 401k, some of these lessons may also apply to a 403b or any other retirement account like an IRA, right? But for me, the context and the examples that I'm using will be coming from my own 401k, which will be relatable to yours, hopefully. I can't say that my first experience with a 401k was overwhelming, right? The way I see it is I would compare it to going into an ice cream shop where the ice cream shop and all the flavors had no signs on them, right? So you had no labels and you had no idea what ice cream that you were selecting. And I prefer to pick the strangest looking ice cream. So since I don't know what's gonna taste like, if I pick something for retirement, I have no idea how it's gonna do, how it will perform, and it could do terrible, right? But I won't know until I taste it, right? So that's not ideal, and it's very complicated, right? Because the goal of a 401k is to help you retire. And if you select the wrong choice or the wrong set of retirement funds and it will affect your ability to retire 40 years down the line. So it's really hard to figure out, did I make the right choice? You won't really know until it comes time to retire, right? So no one wants to really gamble their retirement, right? They want to take lessons. They want to make sure that they do the research and they approach it in a way that increases their success in retiring. And today we're going to be examining, retirement funds, what to look out for on these funds. I won't focus too much on contributions, matches, or anything related to that. More focusing on picking those funds. So basically, once you have your money in the account, what do you do with it? So I know Greg already gave you a quick summary of who I am, but just a little bit more information to add on top of that. I am a CUNY Baruch graduate, and I do come from a low-income immigrant background. And these factors drive me to sort of help anyone else who's been in a similar background. Because if you've been in a similar background, you know that you really didn't have anyone to talk to about money, and conversations around money were rare among friends and family, just because there wasn't a lot of it, right? And because of that, when I first got my 401k, I had no idea what to do with it, right? Everyone else my age was just graduated. They had no idea. They were going at it and they just had to figure it out. Their parents didn't know anything. My parents did not know anything. So it's confusing. Right? So hopefully these workshops do help long term, and I continue giving them. And if they do help, feel free to share them, right? You don't need to keep these workshops to yourself, these recordings, share them with other people. I'm always happy to educate as much people as I can. So throughout this workshop, remember to feel free to interrupt me in the chat. I'm monitoring it. I have a second monitor just for that. So if I see it, I'll answer it, and I'll make sure to go along. And make sure to mute yourself so you don't get caught in the recording. All right, so as Greg mentioned, I'm a software engineer. I'm not a financial advisor, and I'm not a lawyer. All right, so this is a quick disclaimer. This is just information that is an opinion, right? And it's for informational purposes only. So don't use it as financial advice. Don't make decisions because Alan said this, Alan said that. Make sure to do your own comprehensive research, right? The whole point of this is that I give you the tools and then you run with it, right? It's not, it's me telling you what to invest in, right? It's not that. All right, so retirement funds, we could just break down what they are before we move on. When we think about retirement, it's something that's far in the future and it's really hard to imagine. But luckily, there's an entire industry built around this. And we really want to make the right choices right now to ensure that we can retire in the future, right? So for the most part for this presentation, we're going to be focusing on 401ks, but like I said before, they apply to IRAs, 403bs, and so on. And most of us, either now or in the future, have 401k for our employer. And you're here because you want to figure out how exactly do I select these investments, right? In your 401k, you have these things that we can refer to as investment options. Right? So these investment options can come in all kinds of flavors, mainly in investment terminology. Right? Someone said hi in the chat. How's it going? You have a question. I feel like you have a question, but you have a comma, so we'll see how it goes. But most of these investment options come in the form of mutual funds. That's not always true. And mutual funds, for those of you who don't know and aren't too familiar with investment terminology, basically allow you to pool your money with other investors to buy a large number of financial assets. So this can be stocks or bonds or et cetera. Right? Should investments be according to your risk tolerance? Yeah, your investments should be adjusted to your risk tolerance. And I'm going to talk a little bit more about that towards the latter part of this slide. And if you're interested in how to figure out that risk tolerance for yourself, I'm happy to walk through an example once this presentation is over about how I would go about and my approach for that. But like I mentioned, mutual funds, most of your 401ks will have mutual funds. Some 401ks allow you to invest in individual stocks, right? So this is like Apple or Disney and so on. Most that I've seen don't. A lot of my friends who've consulted me about their 401ks, they're mainly mutual funds, right? So chances are your 401k will be will have mutual fund options rather than individual stocks. But keep in mind that everyone's a little bit different. So these are sort of lessons that you can apply rather than this is the fund that you showed in this example, so I'm going to pick this one. And one thing to keep in mind is if you invested in the wrong thing or you invested in something that didn't give you as much returns or as much money that you expected over the past couple of years, your 401k providers allow you to change your selection, right? And this is referred to rebalancing and just basically selling assets and purchasing other assets that are more desirable, right? So that's the terminology for it. And if you want to find more information, you can look that up or wait a little bit and I can talk about that as well. So here is my 401k, right? This is the options that I had when I first started. at my company, Rent the Runway. My provider happens to be Fidelity. Your provider could be some other investment brokerage. It could be Vanguard, it could be Charles Schwab, so on. Right? There's a bunch of them out there, and all of them will have different investment options. Right? So when I saw this, I had 27 investment options. I had no idea what they were. It wasn't very clear. There was just a bunch of numbers on the screen, a bunch of like text on the screen. And unless you've had experience investing before, it's not going to be very clear. Right? It's going to be very confusing and very daunting. Right? So there is a chance that your company also did a terrible job with your 401k provider, which means they've allowed you to, they've basically selected lackluster options, right? Maybe you don't have 27 options. Maybe you only have 5 options and they're all terrible. So that's something to keep in mind. The options that I see aren't going to be your options. Even if you did have Fidelity, our options may not be the same, right? So that's something to keep in mind. So there's a lot of information on this page, and 27 options is a lot, right? Someone asked, what about just pick a target date index fund and call it a day? Great question. I'll talk about that in a little bit, but that is an option for those of you who are aware of target date index funds or age-based funds, whatever you want to call it. It is an option. And if you're doing that, it's fine, right? I see no issues with that. But, not all of these 27 options I have on the page are created equal. If you make the wrong move, then 40 years down the line, you can't retire, right? And that's pretty scary. And I just want to call out that it's okay to be overwhelmed, right? When you're looking at this, I had a lot of friends who looked at this, called me up and said, I have no idea what I'm doing. Can you walk me through this? And, we just got to take it one step at a time and look at each of these options and figure out what's the best approach, right? There's no quick and easy way out of this. Well, there are, right? But they might be more expensive, which is what I'm going to dig into a little bit. But for those of you who have not invested in the stock market before, hopefully you'll find this information helpful. But remember, you don't need to tackle this alone. If you're looking at this and you have no idea, even after this presentation is over, feel free to reach out to me, right? I'm happy to talk about your investment options. Obviously, I can't tell you what you should do. I can tell you what I would do, and you can take that with a grain of salt and move from there. Now, there are several approaches to picking retirement funds. Someone already mentioned in the chat, a targeted index fund. We're going to talk about that in a little bit. But the first approach that I want to talk about is having an advisor, right? A financial advisor. And as we move along with these approaches, there's 3 that we're going to talk about. They're going to increase in difficulty, and they're going to generally decrease in cost, right? So there's a pros and cons to each approach, and the most straightforward and simple option is really using a financial advisor, and which is likely also the most expensive. So before I move to that, someone asked, do you worry about the sale charges? I guess it depends on what do you mean by sale charges, right? So for those of you who aren't too familiar, when you purchase an investment of any kind, usually your 401k provider has to make money in some form or fashion, right? So there are usually fees associated with the assets that you purchase, right? Or the investment option that you pick. So those can come in various forms and terminology, and some may be more clear, some may be more hidden. Right? We're going to talk about some of those fees in a little bit, but I would say if you're not sure at all, the quickest way to find out is to call up your 401k provider and just ask, right, what are the fees? How are they calculated and how much do they cost? That's exactly what I did when I saw a fee that did not make sense, and I just wanted some explanation. If you use a financial advisor, wouldn't you have to remove the funds out of your company's 401k into their company? Well, it depends on how you're using your financial advisor, right? There's plenty of financial advisors, and if you can't really move the funds out of your 401k without facing a penalty of some sort. So you can have your financial advisor just advise you on what to invest in, right? They can just tell you, hey, put 50% in this, 50% in that, and you don't think about it. Right? So they don't necessarily have to manage it for you all the time. You can, if you give them your login, right? So they can take care of that entirely. Someone asked, there are financial advisors that are not commission-based and are structured based on how well the customer does. Is that something that is advisable in terms of who we select? Yes, picking your financial advisor is going to be a tricky one, and people from different parts of the financial sector are going to have different opinions on this. So I would say it depends on what you're looking for, right? Some financial advisors charge based on the number of assets that you have with them, right? So as someone mentioned, your 401k may have a financial advisor. They have charged a fixed fee, like your 1% of your investments, right? So they'll charge 1%. If you have $100, they'll charge $1, right? So think of it like that. Some advisors charge based on time, right? How much time or that they spend looking at your investments. So really you want to pick the one that works for you. But at the end of the day, you have to interview each financial advisor and figure out which one fits your, the fee structure that you prefer and the communications that you prefer. But I don't want to spend too much time on the financial advisor because it's sort of like the quickest way, right? Generally for beginners, I personally would not go with this approach because you should at least try to manage your 401k investment. And if you find that your time is better spent elsewhere, then an advisor is the right move. If you're making so much money that you can't afford to spend time looking at your 401k and you would rather have your financial advisor do it for you because it's cheaper in that sense to have them do it for you, then go for it, right? But for beginners, I would say really think about it because they can be extremely expensive compared to other approaches and sometimes only available to those with high net worth, right? You have to meet a minimum amount of money in your accounts to really even approach them, right? Because they make a percentage of your account. Right? 1% of $100 is nothing, but 1% of $1 million is a little something more, right? So they were like that. So they like clients with more money. And just remember, there's no refunds here, right? If you select an advisor that does a poor job and they lose your money, right? That's too bad, right? So it's important to do your own research and interview your financial advisors before you pick one. All right, so time is valuable, and sometimes your time is better spent pursuing other goals. I mean, that's fine. Just weigh the pros and cons here. And if you want to go with a financial advisor, it's a completely fine approach. It also saves you a lot of time and you don't have to think about anything. Now, next approach is an age-based fund, or what someone already mentioned before. And most 401k providers offer this option. It's not always true, but generally they do offer it. And generally it's the recommended approach for a lot of people who are just starting out and don't want to get a financial advisor or can't afford one, right? Age-based funds are generally more simple because you don't have to do a lot of time researching or managing investments. You basically offload all of this to a fund manager, right? So when you invest in these funds, a fund manager will basically look after your money, right? Make sure it grows based on how old you are, right? So generally speaking, the younger you are, the riskier these funds will be, which also means that the higher returns, right? And the older you get, the less risky they'll be and the lower returns they'll be. That's like generally what it is when it comes to these age-based funds. And it's a completely fine approach. And for those of you who don't know how to sort of like pick your age-based funds, because if your 401k provider offers it, there's generally going to be a couple of them, right? So this is how you would go about selecting them or finding the one that fits for you. There's only one that will work out for you in terms of age-based funds. So the first step here is just calculating your expected retirement year. Right? Generally speaking, people retire somewhere between 60 to 67. Right? It also works best because a 401k, you can withdraw without penalties after 59 and a half. So 60 to 67 is generally the range. Right? So once you figure out what year you want to retire in, then you look for the funds with years next to them and select the fund by rounding to the nearest expected retirement year. Right? So if you expect to retire in 2050, look for the fund with 2050 in its name, right? That'll generally be the age-based fund. And then once you find it, just invest and you're done, At that point, the fund manager will do all of the work to look after your money and reallocate your investments as needed, right, based on your age. Right? So it's very generic, but it works. There's an entire industry built around this. The idea of just throw your money here, don't think about it, and don't look at it. Here's a quick example of someone who is 30 years old today. Right? If you're expecting to retire at 67, right, which will be 2058, then you go down this list of funds, right? This is a screenshot of all the funds that are available for me, and just look for the year that's closest to 2058. In this case, it's going to be the BLKRKLP IDX 2060, which is the BlackRock index fund for 2060. So that's available to you, and if you just put all your money in that, that's fine. There's the formula if you need it. So this is sort of the approach that most people tend to gravitate toward, just because it's so simple to do. Right? Just figure out the year you're going to retire, and just put your money in that, and just keep investing in that every month as you get paid and you get contributions into your 401k. Right? So there's some caveats associated with this, like the fees that they charge may be higher, but if you only want to invest and you don't want to think about anything, this is the approach, right? So, and there's no really other option of waiting. Hey, which fund or which age-based fund is better? There's going to be 1 year, and that's probably the one you'll pick. Now, the third approach is going to be a little more complicated, and we're going to spend the majority of time around this one. And it's the DIY approach, right? The do-it-yourself approach. And it's probably the least expensive option, because you're basically offsetting all of the work that you would expect the financial advisor or the fund manager to do onto yourself. Right? So it's the most time-consuming option, but you might also come up on top just because you will save on fees, and you might even pick investments that will make more money. Right? So I'm going to take a deep dive into this one. And just the DIY approach reminds me of this quote. If you want something done right, do it yourself. Someone asked, can you discuss the Roth 401k or the traditional 401k? Also, is there an ideal return percentage we should be looking for? I can talk about them a little bit, but not too deep. So the Roth 401k is the difference between a Roth and a traditional, right? On the high level is basically when you get taxed. Right? A traditional, you delay your taxes until you withdraw them. A Roth, you're taxed today, and when you withdraw those gains plus your contributions, you're not taxed. Right? So that's high level difference. There are other much smaller differences based on rules around them, IRS rules, tax regulations, and whatnot, which you can learn more about on the IRS website. But if you want to talk more about it, feel free to send me an email after. But I'm just moving around it because it's not the focus of this presentation. And the ideal percentage you should be looking out for, in my opinion, is 7%. Right? On average, the stock market historically has returned 7% every year. Right? So if you're making below 7%, not looking good. You're making above 7%, that's great. I hope that no one withdrew their money last year during the recession, because the market bounced right back and we're higher than we ever were before last year. So hopefully you kept your money invested and you did not withdraw, even though you could withdraw penalty free with some caveats based on new rules surrounding coronavirus. From the recent from the recent law changes, but I would encourage you to keep your money invested. That's what I would do. All right, if you're going to do the DIY approach, you really have to start digging into the nitty-gritty details, which I'm going to inform you is going to be difficult, unfortunately, just because it's not simple, right? It's not something that you can just walk into and just know everything. This is how financial advisors make their money. This is how people who invest for a living make their money. So you really have to dig deep and figure out, what are these funds? There's 27 options. Look into each one of them, right? It's not a matter of looking at picking 5 randomly and saying, hey, I'm going to go with these, right? So someone asked, during the last decade, the S&P 500 has averaged 10%. Should this be a better benchmark as opposed to the 7%? That's a good question. I prefer the 7% benchmark for 2 reasons. Because it's more conservative, and the number was built off of a longer period of time, right? So that's, you're going to retire in 40 years, right? For many of us, or 30 years, or for many of us who are still working, if you're going to retire in 10 years, right? But you're not withdrawing all of your money, right? You're still going to have money invested, right? So chances are your money is going to be invested for longer than a decade, right? So I like to lean on the conservative benchmark and over a conservative timeline. And so there's a lot of talk about, hey, it's looking great. We're booming. We had a sort of recession, but not really. So what does that mean? Hard to say. You should be getting a recording. Yes. All of the questions are coming in. This is probably a pretty basic question that might have been addressed earlier. Apologies if it was. The company I moved to at a future time doesn't offer a 401k plan or the same 401k plan. What will happen? Can it be frozen? Well, it depends on what you mean by frozen, but generally speaking, if you are moving from a company that doesn't have a 401k plan to a company that does not have a 401k plan, right? You just can't roll over your 401k to your new 401k with your current company. So your funds aren't frozen. You just can't put more money into your old 401k because you no longer work at the old company. But your money will continue to grow, right? Continue to be charged fees. Your fees may be higher than before. Right? So when you leave a company, make sure to call your 401k provider for that old company and ask them, what are my fees going to be now that I've left the company? How much higher are they going to be, right? If they're really high and your new company does not offer a 401k, it might be in your best interest to roll over that 401k to a traditional IRA, but that's a whole different topic, right? And I'm not going to say that's the best move right off the bat because it will vary a lot based on your 401k provider at your old company, right? But you have a lot of options available to you, but it's definitely not just going to stop growing. It's going to keep growing as long as you have your money invested in that old 401k. Someone asking, you please explain reading the details on the fund. I will. I definitely will. There's a lot of information on the screen. I'm definitely going to walk through all the relevant ones or the key ones. Obviously, I can't cover everything just because there's a lot there, and not all of it is necessarily relevant when it comes to long-term investing. I know some people use apps like Acorn to do their IRAs since the companies don't offer a 401k plan, but Acorn charges a fixed monthly fee. Would you recommend using apps like this in terms of cost benefit? So I have strong opinions about Acorns or any sort of like robo-advisor sort of platform, because in my opinion, they charge much higher fees than what I could do myself. Right? But that's fine if you don't want to do it yourself, right? If you're okay with those higher fees, then by all means, it's fine, right? In the long term, it might not mean that much to you, as long as you know how much those fees are and how much it will cost you in the long term. Right? If you don't know, I would suggest doing an investigation, and then then you can make your call, right, from there. But if you don't have a 401k, strongly encourage you to open up an IRA. Someone asked, do you put Betterment in that category too? Yes, I would put Betterment in that category. Just because all these robo-advisors mainly charge somewhere around 0.25% in fees, right, for their funds. And either, I don't remember if it goes up or down if you put more money with them or if you make more money. But 0.25% each year is expensive to me. It might not be expensive to you, right? So this is where your investment philosophy, your values of money, may differ from mine, which is fine. right? It's all about just knowing where you're coming from. I see some people might have to jump, and that's fine, right? Just keep in mind that the recording will be sent to everyone that signed up, so that should be fine. Is a do-it-yourself option, literally picking your stocks, like using TD Ameritrade or Charles Schwab. So it depends, right? Do-it-yourself is picking your own mutual funds versus investing in a single mutual fund, which is like the age-based approach, where you invest in a single one and you call it a day. Do-it-yourself approach, you're going to select your own. If your 401k provider provides options to select stocks, individual stocks, then you can, right? If they don't, you're basically picking among mutual funds. What percentage of your income do you suggest contributing to your 401k every year? This is also a very contentious topic. But for full transparency, I put in, I max out my 401k every year, right? So I put in $19,500 every year. That doesn't have to be what you do, right? It depends on what your financial goals are. Are you thinking of buying a home later? Are you thinking about purchasing a car, right? All these things factor into, should you put more money into your 401k, right? So it's more about understanding where your financial goals are and if you should put more in. Most people recommend, as just like a baseline across everyone, just put 15% of your income into retirement or your 401k. I'm of the opinion that that's just poor logic, right? Really, yeah, 50% of your pre-tax income, yes. I think that's poor reasoning, because it doesn't take into account the fact that everyone's financial situation is different, right? Your financial goal is not going to be the same as another person's financial goal, right? So you should really figure out how much you want to retire with, run it into some investment calculators, and if you can't retire with the amount that you need, then put more money in, right? If you're over the amount, keep money to yourself so you can work on the more immediate financial goals, like a home, like just investing in other assets, right? Do all 401ks carry mutual funds only and not individual stocks, bonds, and securities? In my experience, they've carried mutual funds. Right, I've helped friends and families look at their 401ks. They've carried mutual funds, but that's not a rule. I've heard and I've seen in some cases where they do carry individual bonds and securities that are more on the risky side. So it's possible, right? It's from what I know, but I don't see it very often, right? And for those of you who are looking for a job right now or interviewing, if you get an offer, I always like to ask, if you have a 401k, what are your investment options? Because I want to figure out how well the company has negotiated on my behalf and on really the employee's behalf for the funds that they've selected, right? Because you're really limited by how well the company and the 401k provider work together to provide you these options, right? You could have terrible options. You don't know. The only way is to ask. All right, cool. I feel like the questions have died down a little bit. So I'm going to walk into just talking about researching your funds and what to look out for. If you have a background in investing, you've done your own little investing, then you might know this already. But hopefully it won't be too much old news for you, and you can learn a little bit from this as well. But for those of you who have never invested, this is going to be helpful. So basically, you want to find a page on your 401k provider that lets you research your fund, right? Usually it's very obvious where you can go about looking for this. But if you can't find the page, just Google, right? If you just enter the name of the fund and type in Fidelity or whichever 401k provider you have, and you should come up with some information about that fund. And you see a page like this. Basically have all the information that you need to really investigate. Man, look at these questions come in there. It's hot. How about a VA for a GLI? All right, someone's gonna have to break down these acronyms for me. I'm not too versed in these acronyms here. Someone else mentioned Roth or traditional. It depends on what you think your income will be like when you retire, right? Generally speaking, if you think that your income is going to be higher when you retire than now, invest for Roth. If it's the opposite, where you think your income will be lower than now when you retire, then go for traditional, right? Personally, what I do is I do both. I put some money in Roth accounts and I put some money in traditional accounts because I want to diversify the tax risk. All right, really remember the difference between Roth and traditional is one, they get taxed. Right, so if you're making more money now than later, you want to delay your taxes to later. Oh no, life insurance. That's always a hot topic, life insurance. I don't have any comments on life insurance because it's different for everyone, and very far from this presentation. But if you're interested in learning more, I'm happy to send you information on life insurance. There's a lot of readings out there, but I think in the personal finance space, there are very strong opinions for life insurance. Some people believe, only get term life insurance when you're younger. Some people believe, hey, never get whole life. It's hard to say. I'm not saying I do either. Not saying I'm for or against either approach. There is just a lot of information for life insurance. And I think that really what I think is if you have any dependents, right? If you have to support people and they can't live without your income, look into life insurance. Regarding which type of life insurance, that's going to really depend on your situation and where you're coming from. Because there's just too many factors at play to discuss at the very immediate moment. Someone asked, do you recommend a combination of Roth and traditional? I guess you have my answer. I do both. You might want to do both. The reason I do both is mainly for tax risk. Right? I want to make sure that I have no idea how taxes are going to change in the future versus now. How much of both, like equal split? I would say it's not equal. I would say I put around 33% is in traditional and 66% is in Roth. That might not be for you, right? You might want to do something different, but that's what I'm doing, at least right now, my approach. All right. I'm gonna focus on these investment terms. Rate of return. This one I think should be relatively straightforward for many of us. It's basically the gain or loss for an investment, and it is usually expressed in a percentage, right? So example, if you invest $100 and you make $7, then your rate of return is 7%. If you lose $7, then your rate of return is negative 7%. Pretty straightforward, and relates to the question that people were asking: how much money should I expect to make from before? Rate of return is directly correlated with risk, right? And risk is the chance of losing money. And so what this means is the higher rate of return means higher risk. Lower rate of return means lower risk. Good rule of thumb is when you're younger, you want a higher rate of return / risk because you can afford to make up that money if you lose it, right? You have a longer timeline until retirement. When you're closer to retirement, you're gonna need that money immediately or soon. So you wanna have a lower risk, right? So these are just like good rules of thumb across the board. But you may have a reason to invest differently. But generally speaking, this is the approach that most people take on. So to find information about rate of return, you can look for this hypothetical growth of $10,000 that usually will exist on that page, the researcher fund page that I mentioned when you Google for your investment. Do you think people over 50 also do the catch up? That's a good question, right? I'm pretty sure there's statistics around that somewhere out there, but I believe that they would or they should. right? If they're behind. For those of you who don't know, once you're over 50, the limits for how much you can invest in an IRA or a 401k goes up because you might not have invested enough in your early years, so you want to catch up. Isn't traditional IRA only available for people with a AGI up to a certain level, or do you mean non-deductible traditional IRA? Yes, all of you are going into those very specific IRS scenarios. The traditional IRA, I think you're talking about the Roth IRA. The Roth IRA is only available to people with an AGI up to a certain level. I think it's around like 130 to 140 for single people. But there's ways to get around it, right? If you're curious, I can send articles about that. But if you just want to Google it, just look up backdoor Roth IRA. Right? It's a little bit more forms to fill out during IRS season. But as long as you know what you're doing, you should be fine. Right? As long as you do appropriate research, you should be fine. But there's stuff like that, right? So for those of you who are wondering, what are these contributions and how they affect me? Just Google traditional IRA, IRS, and that should have all the information that you need on the IRS website. Right? So I don't want to replace your need for a tax consultant, right? Or an accountant. Just keep that in mind. But once you get to one of these pages for rate of return, you should see something like this. And basically what this graph is telling you is if I started with $10,000 in 2011 and I took a look at my investments again in 2021, how much money would I have made, right? In this case, we're looking at the FSMAX investment, right? This is the mutual fund that we're looking at. And it basically increased from $10,000 to $32,000, right? So this is not going to be true all the time, right? Not, every 10 years, it's not going to triple in value all the time. So historical returns are no guarantee of future returns, right? That's like a saying that people repeat over and over, but it's true to a certain extent. So just take a look at these graphs and figure out, is this investment that's high growth, right? Is it growing a lot over the years? And if a nice line chart is in your preference, you do have the option of looking at them in a number format, right? So you'll see here that in 2020, that fund increased 32%, even though we had a pandemic. It's kind of crazy, but that's what happened. And you can see some years are down, some years are up, right? You're not going to find a fund that's up consistently and high all the time. So some years are up, some years down. What matters is that there are more years that are higher that can make up for the years that are low. Right? So that's something to keep in mind. But this is the rate of return. You can just analyze each fund, compare them. You want to find the fund with the highest return, right? As a young person. If you're on the older side, you want to find a return, that's not as high because that means it's riskier, right? So you want to weigh your trade-offs there. And this literally means you have to go through those 27 options and see what the returns are like for all of them. And so it's not an easy task. It's more of like, you gotta do your research. You gotta figure out where everything stands. And some tools will allow you to compare so you can more easily see all the funds. So, you'll see comparisons like this where you can have all the funds listed and you'll see which one grew the most, right? So that's something to consider. Now, next thing that we want to talk about is expenses and fees, right? This one is also very simple, right? It's just that you need to pay to invest, right? Trading platforms, brokerages, investment firms do not work for free, right? If anyone's been following GameStop and they saw the debacle with Robinhood, they'll know that was not free, right? Robinhood is not really free. There's, someone's getting paid somehow to make things work, right? Luckily for you, most 401k providers are more straightforward, right? Your company pays the money and you pay them money so they can grow your money for you, right? So they grow your money and they can make more money, right? So they allow you to invest and there are fees for doing so. I'm just gonna pause a little bit to Look at some questions. If you have both a traditional and Roth, is the max contribution $19,500 combined? Yes, it's combined, right? So if you have a Roth, a traditional and Roth 401k, right, the max is $19,500 combined. Right? You can also find that answer on the IRS website. And it's separate from an IRA though. So an IRA is $6,000. So, but the same idea applies, right? A traditional Roth together, the max is the same number, right? It's not separate. You can't put in like 39K across a single year. Do you recommend we should all have a 401k and IRA if we can afford it? I think that the one thing all of us have in common is that we need to retire. I know some people, especially on the younger side, say something like, I'm gonna work forever. I'm gonna live forever. Not gonna happen, right? I think that you really wanna reevaluate there because you want to enjoy life at a certain point. And although you have ambitions, something, you have a physical limitation. You can't work if you get to that level where you are not physically capable of working anymore. Right? So everyone has a common goal of retiring. If you say that you found the secret to immortality, please share it with me. I would like to know. Otherwise, start saving for retirement. Right? It's very important. And even if, for whatever reason, whatever happens, right, you have a bunch of money and you never get a chance to use it, you can still pass it on to your kids, your relatives, and so on. Right? So it's still a good idea to save for retirement. Someone has a question about weighting a portfolio between large cap, mid cap, and small cap. How do you manage the allocation? And is there a particular rule of thumb you would follow? For those of you who don't know what that question is and went over your head entirely, that's okay. We're going to talk a little bit about that in these slides, and maybe I'll talk a little bit about that towards after this presentation is over, for those of you who want to stick around about my approach to it and how I would get started in that regard. But we'll talk about diversification in a bit. So expenses and fees, right? Your fund manager, these are the people and their team decide what goes inside of a mutual fund, right? So expense ratios is the yearly fee paid to maintain the fund, right? Usually this is expressed as a percentage of your assets. And so for example, if you invest $1,000 and the expense ratio is 0.05%, it means your yearly fees come out to be 50 cents, right? So pretty straightforward math. And a 401k provider can charge other fees, right? So I would suggest you call or email your provider. That's what I did to figure out the exact fees that they were charging. And also, the fees can change at any time, right? They're subject to change. They don't have to stick to exactly the fees they've mentioned forever and indefinitely. So you can find these in a section called expenses and fees. Really straightforward. There's expense ratio gross, expense ratio net. You want to look at net. In this case, they're the same, but sometimes they do differ. Net is the actual fee that they are charging you in that very moment. It may change at some point to be the gross. So you want to consider both numbers. And then you see other fees in there. In this case, just distribution and service fees are 0%. So it's not something that you have to worry about. But you want to check out the section to make sure that you know what you're getting yourself into. Because there is an argument to be made that if a fund is returning 30% every year, but they're charging 25% every year, right? Some crazy number, then you're only really making 5%, right? So that's something to keep in mind. It'll negate your returns, right? What would you say is the next best option to invest and save for retirement besides having a 401k? I think a lot of people mentioned it already in the chat. Having an IRA, right, individual retirement account, is a great start, in my opinion. Right, it's worked out great for me. I started an IRA before I had access to a 401k. And I still have one today, so it still works for me. What is reasonable fees? Is 0.45% fee for a target date fund a reasonable fee? I think everyone has their own preferences for what's a reasonable fee. Um, Personally, I like to keep my fees as low as possible, right? So a fee like what we're seeing right here on the on the board is something that I would consider reasonable for myself. If you're investing in a target date fund, you really don't have another option unless you start going with the DIY approach and doing it yourself, because the target date fund is designed for the year that you retire, right? So you're sticking to that fund, and there's no like affordable option unless your company offers other target date funds that are the same year, which doesn't really make sense for them. Um, so if you really want to decrease your fees when you have a target date fund, probably the best option, barring that you have another target date fund that works for you, is doing it yourself. Right? I like to do it myself because it decreases the fees, and my investment philosophy is very simple. So there's not too much work on my end for that, but there might be more work for other people. Um, would it make sense to have a target date fund and also a DIY on the side? Yeah, I think that a target date fund is obviously the safer investment, because you're having someone else, professionals, manage your money, and hopefully they'll do the right thing. And chances are they'll have more resources and tools than you. And a DIY is something that you can do it yourself and see how well it goes. Right? If you're doing really well in your DIY and you're making more money than the target date fund, and you're okay with the amount of work that you have to put in, consider switching it all over to a DIY, right? As long as you're comfortable with the risk, right? Because the DIY is always more risk than a target date fund, because you can reasonably select the incorrect investments, right? That's a very real thing that can happen. All right. We went through returns, fees, obviously on uh, that slide before where you saw all the information and all the graphs. There's a whole bunch of other information, right? So I would say if you see a fund that you really like and you're going to invest in it, make sure to read the prospectus, right, before you actually invest. Now, the prospectus is, think of it like a brochure for the index fund, right? The fund that you're investing in. They'll basically tell you, where your money is going, how they're investing your money, and what the returns are, what the fees are. They'll break down everything for you in the most detailed manner as possible. The trade-off is that it's not pretty to read, and you can clearly see straight away with the screenshot. It's going to be an ugly document, which is fine, right? You want to optimize your returns, or you want to make as much money as possible. So you're gonna go through this prospectus and really understand what's happening to your money. I mean, if you're happy with everything that you read, uh, then go ahead and invest, right? I always encourage people to read the prospectus before they invest, because then they'll know, where your money's going, how it's being handled, what the fees are, and what the returns are, and so on, right? So you want to have as much information as possible. A couple more questions. Don't apologize for asking a question. I just want to be clear about that. Ask the questions, right? This is a good time to ask questions. If I'm not going to answer, I will defer, and you can ask me after. But don't apologize. What are your thoughts on taking advantage of an HSA and 529s if your company offers a match? Right? It's basically free money, so it would make sense to invest and get the match even if you pay a 10% penalty down the line. Well, an HSA and a 529 are for specific purposes, right? In the case of an HSA, it's for health, right? You can use it to pay for your medical expenses. I would say that chances are you probably will not pay the 10% penalty, because you live in America and healthcare is very expensive. You're probably going to be using it for health expenses, right? Like, realistically speaking, that's probably what it's going to be for. But it is free money, right? Like you said. And if you really think you're going to end up paying that 10% penalty, do the math, right? If you start investing today and you get the free money every year until you retire, and the money grows over that period of time, how much is that 10% penalty really, right? Is it worth it, the trade-off of that 10% penalty? Right? Only you can really answer that question once you do the math. Right? You can use investment calculators and you can figure it out from there. But I would strongly encourage you to figure out what that end number looks like, right? Even if it's just for, you know, it's just predictions, right? It's never accurate per se, but it'll give you more information to help you make that decision, right? Rather than saying, hey, there's 10% penalty and I get free money. How do I weigh those two? You want to weigh the end result. I read the prospectus. Do you have three things to look out for? I would look out for what the fund is actually investing in, right? So they could say, hey, we invest 200%, like 20% in Apple, right? Do I feel comfortable with 20% of my money in Apple, right? So the prospectus will break down how they're investing as much as they can, right? That's what I'll look out for. The other thing is the fees, right? They're going to break down the fees, and you can see how much the fees are and how those are being calculated, right? So that's something I would also look out for. And the last thing is likely what the goal of the fund is, right? And they all sound sort of similar, but it'll help you figure out what they plan to do in the future, right? Because the prospectus is just a snapshot in time, right? So it's subject to change, and they're free to change it, and they will send you information when they do change it, but you want to make sure you're on the right path. For the 401k, at what moment do you get charged for the management fee? These fees are quite a tricky thing, especially when I asked my 401k provider to explain it to me. So these fees come in a couple of different flavors. Some of them come right out of your 401k account, and you can see it, like it'll be like minus $30, right? It'll happen every quarter, right? And some, like an expense ratio, you don't see at all. It comes out of your fund returns, right? So you never see the fee, and your fund manager will just take it out of the fund as they go along. But if you really want to figure out how your 401k and your investments take out those fees and how often, call your 401k provider. They'll have the answer for you, right? It's going to differ. There's no like flat rule that it has to be this way or it's that way. So they'll know best, especially for your situation and your investments, right? Which will, chances are, be different from mine. All right, moving on to diversification. Someone asked before about small cap, medium cap, and large cap. We won't end up talking about those too much because that's more advanced, but we will talk about diversification on a high level, and I will link to more information that hopefully you'll read and you'll get a better idea about, and you have a better understanding of the question that someone asked before. So I'll be first to admit, diversification is a confusing concept. You hear it everywhere. It's one of the first topics that come up when it comes to investing in your finance classes, in your own stock market research. You'll see, hey, make sure to diversify, but we won't really tell you what it means, or it will be confusing, right? And there's no right answer to diversification, right? It's really up to you to determine what assets you want to invest in and how much you want to invest in each asset, right? So there's no straightforward answer, but there is a wrong answer, right? This is, and that is putting all of your eggs in one basket, right? In other words, you're investing in a single asset, right? So a good example is if you put all of your money into GameStop, right? I know it jumped 100% today or more, right? But is that a safe move? That's not a move would follow the good practice of diversification, right? So although you made money, is it going to be good for long term? Hard to say, but you're really being risky there, right? So you want to make sure that you diversify, and really diversifying reduces your risk. And but to boil it down, it just means you have to invest in more than one investment option. Right? So you have I have 27 options. I had to pick a couple, not just a single one, and say, hey, I'm just doing this and that's it. Now, if I was to describe diversification in a single line, it would be diversification is a continuous and biased risk management strategy requiring a deeper understanding of different asset classes and risk factors. It's continuous because you have to constantly reevaluate your risk tolerance based on how old you are and your life changes that may have happened, right? And some investors look at their retirement accounts every month to make sure that they are diversified and numbers haven't changed too much, right? So the process is biased because everyone's tolerance for risk is different. I'm on the risky side. Some people are more on the safer side, and that's okay, right? It's just about understanding what your risk tolerance is and being honest about it. And the most difficult part about diversification is knowing the bits and pieces, right? And that's really the deeper understanding because that's an entire presentation altogether, right? There's no amount of explanations I can do in this presentation that will clear up those different asset classes and risk factors, right? So much of small cap, medium cap, large cap already that's flying over some people's heads. That's because it's confusing, right? Now we can think of diversification as reproducing the results of an age-based fund at a lower cost. Right? So you're basically picking your own investments. In this case, it's picking your own funds, and it'll be a lower cost because you're doing it versus paying someone else to do it, right? So you're offsetting the cost. How many stocks do I need to hold to consider my portfolio diversified? I would say it depends, right? It's less about how many stocks you hold and rather more about how many different asset classes that you hold, right? And everyone's tolerance is different when it comes to this, right? If you're okay with investing everything in stocks, maybe not one stock, but like everything in stocks, that's fine too, as long as you are aware of what you're getting yourself into, right? That's the difference between gambling in the market, in the stock market, and having an understanding of what you are risking and how much you can gain and potentially lose, right? And you have the freedom to make these decisions, right? It's all about if you know what you're doing, right? If you make the wrong decision, you obviously lose money, right? And if the right decision can make you a lot of money and maybe more money than the two other approaches. How many stocks do I need to hold? Oh, answer that question. For those of us in the public government sector, understanding what you've shared about 401k investment plans, how do pensions differ? Oh, pensions. For pensions, you don't get. I've never had a pension, so take what I say with a grain of salt. My understanding of pensions is that you don't necessarily get to choose your investments, so you're at the mercy of whoever manages your investments, which I'm not a fan of. And if you've done readings about pensions, you'll know that they don't have to pay you out necessarily. I've seen things where companies would spin up a different company and move all the pensions to that new company and then bankrupt that company, so they no longer have to pay pensions, right? So if you have a pension, but if you have a government pension, generally speaking, that's safe. If you have a private sector pension, maybe a little bit tricky, right? So if you get a return of around 6 to 7%, seems fine, right? I would say that's the average. But I would say talk to people who might be a little bit more older at your company, so you have a better idea about how they're seeing it and how pensions have worked out for them. But I think if you have a pension and you have no control over your investments, consider opening up an IRA if you haven't, or opening up a brokerage account, right? There's less tax benefits, but still beneficial to you. At the end of the day, diversification is about managing your risk tolerance, right? You dictate what to invest in. And there's a lot of terms, a lot of terminology. I don't want to dig too deep into it per se. So I would, this is linked on Investopedia, which is a great site to read more information for how diversification is necessarily defined and how you can diversify, right? We're just going to go over a simple example here. And it's not going to help you understand everything, but it'll give you an idea of anything. Right, so a young professional can afford more risk. Right? That is pretty straightforward, right? And if you're a young professional, you decide, hey, I want to invest 90% in stocks, which are risky, and 10% in bonds, which are less risky, with a focus on the US. Right? The international is an option, but we're not going to talk about that because it complicates things. So we'll focus on the US, right? If you add international, then you're diversifying further. So from that, I look through my 27 options and I look at what's a stock and what's bonds. Right? Usually they will say, hey, this is a stock investment. This is a bond investment. So the categories should be defined for you already. And let's say out of all the stocks, I say I want to put $900 into FSKAX because it has the best returns for the lowest fees. Right? Same for bonds. I put $100 into LLDYX. Right? Best returns for the lowest risk in that asset class. Right? So which makes the ratio 90-10. Right? So you basically, the idea is to come up with a ratio and allocate your money in that pattern, right? In that way. Now the thing is that ratio is not going to necessarily stay the same in your investments because we expect our investments to change in value over time, right? And that's how you make money. Since your investments will grow at different rates, then it's reasonable to believe that eventually those investments will no longer maintain that 90-10 ratio. So you see here in the chart, you start out your initial investments, 900, 100 makes up 90-10. Let's say 2 months later, your stocks more than doubled in value, right? Probably not going to happen, but for the sake of argument, that's what happened here. And now it's worth $2,000. Now that makes up 94% versus 6%, right? So you no longer meet the 90-10 diversification target that you set out with. So now you have to rebalance. What that means that you need to sell an asset and buy another asset to get back to that 90-10 ratio. In this case, you're selling stocks because you're overexposed in that area, right? You have too much money in stocks, and then you're buying bonds, and you get back to that 90-10%. So the one thing is make sure that you double check that there are no fees, or if there are fees, you know what the fees are when they're associated with buying and selling investments. If you plan to rebalance often, right? And some people rebalance every month. Some people rebalance every year. It really depends on your preference and how much time you want to invest into this. But your value of your investments will change over time, and you will eventually leave whatever target you set out with. In this case, 90-10. What are your thoughts on performance weighting strategy? I would say that that's a tough one. You want to put more money in assets that perform better than the ones that don't perform as well. But you have to acknowledge that that's more risk, right? So, so it's a tough one. I like to keep it simple. I like to understand all of my risk. I like to have things in safer asset classes when I need them to be, even though they may not return as well, right? Because I have an understanding that it's not going to make me as much money, but it's safer, right? So I want to have that safe investment versus always going toward the assets that perform the best, because we never know what's going to happen in the future. And ideally, when things go terrible, you can have some bonds that will protect you and that are less risky. All right, now to summarize some key notes here, right? First thing is do your research and invest for retirement. Someone asks, hey, should I invest? In the chat before, you should always invest for retirement. You should do your research when it comes to that. Hopefully the links I'll provide, these slides and this recording will help you. And the DIY is not up for everyone. Age-based funds are just fine, right? If you have an age-based fund, and the fees are a little bit on the higher side, that's fine, right? As long as you're okay with it. And if you're not okay with it, then start looking at the DIY approach and start doing some research. But it does take more time, and it's not as straightforward. Right? And your employer may offer financial advisors, right? I'm not saying they're recommending financial advisors and you have to pay for them. Some companies offer financial advisors that they've paid for. Right, so reach out to your HR, reach out to your benefits department to see if that's available to you. And if it is, go ahead and use it. Right, there's no reason that you should hold back because they're great resources to ask questions, right, to figure out if this strategy works for you. And lastly, don't be afraid to call your 401k provider if you don't understand something. Right? You have to remember that your 401k provider only makes money if you invest and grow your money with them. Right? So they have an interest in helping you select the best investment that work for you. Here's a few questions. What do I do with extra savings after you've maxed out annual retirement contributions? Should you not invest money meant for a down payment? Extra savings, I think that depends on what your personal goals are. For me, I'm thinking of purchasing a condo, right? So my significant other and I are saving towards that goal. And your goal may be different. Maybe you're saving to go back to school, right? Or to learn a new skill, which is fine, right? Or a new car, right? Or a used car, right? Probably never new cars. So it really depends on you. Or you can just put money into an individual brokerage, right? Into a brokerage account with no tax benefits per se. So you can just stay invested. And someone asked you, not invest money meant for a down payment. This is really, it depends on where you're coming from. Right? If you have to purchase a home, next year, don't invest your money, right? Because it's really close. And if your timeline is not flexible, and if the stock market just dips and drops, then you can't purchase your home. And if you're more flexible, you have more time, maybe purchasing homes like 10 years away, then you can consider investing your money. But really, it depends on how flexible your timeline is, and if you're okay, with losing that money, right? That's what it really comes down to. Do you have a recommendation for someone in their 50s who's never had any type of retirement funds? I would say someone mentioned catch-up contributions, right? If you have a 401k, invest in the 401k, right? If you can afford to max it out, max it out. Right? I think if someone's already in their 50s, they're a little bit late coming to the game, but it's not the end of the world. Right? You still have, give or take 10 to 15 years to build your wealth in retirement, unless you have other assets, right? And it's not the only way to retire, right? Something to be clear about. But otherwise, try to max out things that you can afford to do so, right? If you don't have a 401k, look into an IRA, right? There are other options out there. Can my employer's financial advisor tell me what I should invest in based on my age? Yes, they should be able to. If they can't, then I would say that they have no business being a financial advisor. But you can also find this information yourself online. What about performance difference between stocks and real estate? Why buy real estate versus rent? Is it better to rent and invest in stock? You're all asking these hot topic questions, especially if you're in New York City. Well, I hope if you're in New York City, you took a walk outside today because it's great. But I think it just depends, right? The thing with real estate is that so much of it depends on where you're buying real estate and if the value will go up, right? So rent and investing in stocks, right? It can make sense. I would say take a look at crunching those numbers, right? The money that you rent, what if you used it to pay for a house of the same value, right? Not that you could find one in New York City, but what if you could, right? So I would say take a look at your real estate market and if it makes sense, right? So run the numbers, I would say. One thing I will say is, historically speaking, the value of real estate does not increase as fast as the value of stocks on average. But the thing is, that's looking at the real estate market as a whole, but your home is going to be very individual, right? So it's going to be very dependent on home improvements, on your neighborhood, right? So it's harder to say, but you can make the argument, hey, if I buy real estate, I can rent it out and I can become a landlord and I can make money that way, which is more, could be arguably more secure than the stock market. What tax deductions from mortgage payment cover more than the returns you get from the stock market? Again, it depends, right? You can deduct, for those of you who don't know, you can deduct your interest for your mortgage. And usually in the first couple of years, it'll help you a lot because you pay a lot of interest up front, just how mortgages work. But, maybe you'll have, cover more than the return you get from the stock market. But another way to look at it is real estate is really another form of diversification that's more tangible than the stock market. And in like an ideal world, you don't have all of your money in the stock market. You have some in real estate, you have some in stock market, maybe you have some in cryptocurrencies, you have some in bonds, right? Just spreading your wealth in multiple places so that if one area fails you, you still have another area that can go up in value. Right? So I would say it's not black and white. Real estate can do wonders depending on where you are. Whenever, for instance, performance weighting strategies, I'm referring to rebalancing mutual funds, meaning at the end of the year, move money from the best performing mutual funds to those that are doing worse. The theory is that the best performing funds will most likely not perform as well the following year. So it makes sense for the underperforming fund from the prior year will do better than the next year. Huh, that's interesting. I have not done that, but something that I can look into. Complete transparency, since I'm on the riskier side, I invest 100% of my money into stocks, right? Stock-based mutual funds. That may not be the strategy for you, and I invest in only a single asset, which is the total market index fund, which invests in 3,000 plus stocks in the US stock market. So that might be something that works for me, but not necessarily for everyone else. But it also means I don't have to think too hard about rebalancing because I'm only in one asset class. But again, that depends on your age, where you're coming from, and what your tolerance is. But that's an interesting strategy. I'll take some time to read more about it for sure. Someone asked, like BT Sachs? Yes, like BT Sachs. So that's definitely what I do. Not saying you should do it too, just being transparent here. Renting means tenants and a lot of work, even if you have an agency. My tenant destroyed my apartment and cost 40K in rehab. Look at the risks. Yes, take it from a landlord. I think it's a hit or miss, really, in my opinion. Growth versus value stocks. Which ones would you recommend and what sector? Look at all those great questions. I'm gonna pause on those questions for a bit and just wrap up these slides. So I do have this free service that I provide, right? Financial literacy coaching. It's basically a free 30-minute session with me to talk about your financial situation, and I can answer questions. And I'm not gonna tell you exactly what you should do, but the goal is to teach you how to find the information that you need. Right? You can sign up through this link here, and let me just post it in the chat. But it looks like this. So if none of these times work for you and you're still interested in chatting with me, then just reach out via email. Right? I'm always happy to chat. But otherwise, feel free to reach out through here, and we can have a phone call or we can have a Zoom meeting. And I'm fine with either one. But yeah, if you are in a situation where you want to chat and you don't have anyone to turn to, I'm happy to help. Right? My only request is that you share the information. You don't just keep it to yourself, right? I think everyone would have a better life, really, if they shared financial literacy with everyone rather than just keeping it as like a secret. Right? This is what people are normally doing now. Yes, and check out my blog, right? Check out my blog. It looks similar to this. And I write a bunch of topics about a bunch of things. So feel free to check that out. All right, look at that, Greg, just pitching in and sharing that blog. Yeah, so check out that blog. I don't write on it as much or as often anymore, just because I'm working on a new YouTube project. I think that there's probably a better approach to reaching just people in a larger audience, especially the Q&A audience. And thanks for sharing that link. Definitely check that out. But what that looks like is this. So this is the YouTube channel that I will be posting videos on eventually. Oh, look, people are already signing up for stuff. I'm getting emails already. But feel free to subscribe if you want, right? I'll tell you to like something, but I have no videos yet, at least not yet. I'm hoping to put something up in the fourth quarter of 2021. But otherwise, I'm hoping to talk about just being a first generation college student, software engineering, and financial literacy, and FIRE, if anyone who is aware and know what that means, just financial independence and retiring early. But yeah, check that out, subscribe if you want. And I want to be here for as much as I can for everyone. And the next workshop is on March 31st at 6 p.m. On how to research financial literacy. If this workshop goes well, then hopefully you'll never have to talk to me again because you'll know how to find stuff. But if you still want to chat, I'm always here. But for that workshop, bring as much people as you can, right? I want to make sure that everyone learns about financial literacy and you can share their knowledge out.
And Alan, I just put the link to sign up for that one in the chat. So we definitely hope to see you all at the next one in March. That's going to be a good one. And you'll be able to research financial literacy. And like Alan said, you won't need Alan anymore. Although you'll still want Alan. Yeah, we'll still want Alan's insight. Thank you so much, Alan. And thank you to everyone for your great questions and your engagement. This was a really interesting session, as always, Alan. As Alan mentioned, feel free to sign up to chat with Alan if you have some more specific questions and more nuanced things to talk about. His calendar link he shared earlier, and we will also share the slides and recording of this afterwards. So you'll be able to check out all of the links and other things that Alan shared throughout this presentation. So I've got that link there for the next session. I also wanted to just quickly share in our most recent alumni magazine, in case you had received it, you may have noticed there was a story about Alan. So I'm going to actually share that here as well that you can read online, a little bit about Alan's background and what led to him doing these presentations for us and for Baruch. So definitely check that out as well. Just put that link in the chat as well. Thank you again. And yes, Mandy, we will send as many links as we can via email. We'll send the recording link. We'll send the slides so you can then consult everything that Alan shared. And we will also send the RSVP links for our upcoming event with Alan as well. And we hope to see you there. Yes, the chat messages, it can be difficult to keep up with all of them. So no worries. We'll send you links in the follow-up email. Thank you again, everybody. This has been really interesting. I think that we can all tackle our retirement now from a more informed place. Alan, are there any final words you'd like to sort of end with?
Yeah, I would say during these sessions, unfortunately, I don't get to every question, right? If I missed your question, feel free to shoot me an email. I've had people shoot me emails after to just chat more or sign up for a session, right? I'm always happy to chat. But otherwise, I would encourage everyone to do more research and really share this research as well. And just when you can tell from the chat, there's a lot of information that's missing from just everyday life when it comes to financial literacy. And if you can just share the information with other people, I would appreciate it, right? And just share information, let people know, hey, I'm doing this, what are you doing? Will this help you? And so on. Just because my goal is to make sure that everyone can retire, everyone is financially literate, and really improve people's lives. Because you're a first generation college student, if you come from an immigrant family, low income, it's really tough, right? So we want to help each other. We want to make sure everyone gets really makes it up there and gets pushed up there.
Excellent. Thank you so much, Alan. Thank you again to everyone for being here this evening. We look forward to seeing you again at another event soon. And until then, thank you very much, Alan. Thank you, everyone. And we'll be in touch. Take care. Have a great night, everyone.